This is the Value Investor Podcast with Tracy Reinick. All things value, all the time.
Welcome back, value investors. So this week's episode, I wanted to look for dirt cheap stocks because why not? We want to know who's the cheapest right now heading into earnings season with the highest Zacks rank. So I only looked for Zacks number one strong buys. Now this is a little peculiar going into earnings season because a lot of the Zacks ranks are going to change dramatically during the season because that's when the company will report. The analysts will, see what they've done. Maybe they beat, maybe they missed, maybe they beat and raised, or they cut guidance, or they're giving, lower guidance for next year already. Whatever they do, it's going to cause a lot of changes in those estimates. The analysts are going to go in and revise, which they do every quarter. And that's when you get the changes in the Zacks rank. So remember what the rank actually looks at. It looks for analyst revisions on the earnings estimates. So is someone raising their earnings estimates for the full year? And right now, because we're in October of the year, it's looking at next year's consensus and those earnings estimates for next year. So is someone raising or cutting for next year? Are there several of them doing it at the same time? Is it a big magnitude of change? It looks at all of these factors, puts it into the computer algorithm. So it's not someone here at Zacks sitting there trying to determine the rank on all of these companies. It is the computer who throws it into the formula for the rank, and then that's where you get the new rank. Now, the rank can change daily. It is run daily. And during earnings season, we'll be getting hundreds of changes per week, if not thousands in some cases, on the various companies and with those analysts' estimates. So that's why it changes a lot during earnings season. And so looking at it ahead of earnings season is a little bit different way to see who is cheap and who has the number one rank. Now, it could be some of the companies with the number one rank simply did something or reported late in the last earnings cycle. So if they reported in August, that's not quite in 60 days for many of them yet. And so those old estimate revisions are still holding up for some of those companies. And I did notice that when looking through the stocks that I picked out of the screen that I ran. But it still gives you very bullish indicators with these companies, or at least things aren't as bad as what, we're thinking is going on if you're looking for the Zacks number one ranks. Now, it doesn't necessarily mean there's earnings growth. People kind of get that confused a lot of times. It simply means that the analysts have raised their earnings estimates. Usually it means nobody is cutting. And if there's more than one analyst on the company, it means that they're in agreement with what's going on there. So it usually foreshadows something good is going on if those estimates are on the rise. But you never know. That's why you have to look a little bit deeper than just what the rank says. So I ran the screen with a Zacks number one rank of strong buy and a PE under 10 to get the dirt cheap. I don't like running with it much lower than 10 because then you start to get some stocks where you're like, why is it so cheap? Why is it trading at, 4 times or 2 times? Something else is probably going on at the company, given it would be that cheap and the market is still ignoring it. Nobody's talking about it, that kind of thing. So that's why I use 10. And most of the stocks on this list were between 5 times and 10 times. And this is forward PE. So what do we mean by that? It's looking at the future. It's looking at these estimates that the analysts are giving and saying this is where the stock is valued based on what they think is going to happen. Now, some people hate using that because no one knows if this is going to hold up. And if we're looking at 2025, we have to start asking, that's a while in the future. Who knows what's going to be happening even a year from now? But the other option is to use the trailing PE, and that you often see on sites like Yahoo Finance. It'll say TTM, and that is looking at what happened in the past. But I don't like to use that one because a lot can change in just a year. I mean, think of NVIDIA a year ago with its earnings versus today. So it's not going to capture these breakout stories if we're looking at the past. But neither thing is, 100% accurate because the company's only valued at what it is like in the very moment you're looking at it. But I still like to go with the forward because I am an optimist and I do like to buy my companies based on their growth potential and things they may be doing on the earnings side, in the next year or maybe 2 years. So we do use forward PE here at Zacks, and I like to use it as well because we are future looking at the stocks we're trying to buy. Okay, so I ran this very basic screen. Like I said, just Zacks number one rank, PE under 10. I didn't even do stock size. I didn't do dividend. I didn't do anything else with it. I didn't even do share price. I didn't even ask it to do over $5. And I still got 45 stocks. So that was much more than I thought I would get, even though there's over 200 Zacks number one ranks. But to get that many with a PE under 10 was surprising to me because that is dirt cheap. And that's a lot of dirt cheap stocks with the strong buy. But a lot of them were Chinese stocks, and we know those are dirt cheap. So I kind of ignored those because I did not want to look at those right now. And then a lot were just smaller caps and stocks maybe you never heard of or you never would consider. So on this list, we're not getting, the Mag 7 at all. We didn't get any really well-known, like large cap names that I could tell on there that were American. So keep that in mind. That is also interesting that this screen mainly gave us small and mid caps. I'm not sure what that says totally, except that with the small caps, usually you have one or two analysts covering it. So we might have just had one analyst on a company. That person is raising the estimates, and that's how it's able to get the number one rank right now before earnings season. So that could be. But I picked out 5 names, and one of them I had to ditch because I wasn't sure what it was, even though I knew I'd heard it before, and I know I've covered it on this podcast before, but it's one of the mysterious names and tickers, which I'll reveal in a minute. But I still managed to find 5 that, look kind of intriguing, and they're cheap. So let's dive right in. The first one we've talked about on this podcast before. I haven't looked at it for a while, since 2022, when the shares blew up along with a lot of the other big tech names, and it really just crashed down. And this stock is Digital Turbine, ticker A as in Adam, P as in Paul, P as in Paul, S as in Sam. APPS. It does have the number one rank, but its style scores are actually not that good. D for value, F for growth. Does have an A for momentum, though, but an F VGM score. But we didn't screen for that, so that's why we're getting bad style scores. It only has a market cap now of $311 million, so this is a small cap. And if you remember, this is a mobile growth platform for advertisers, publishers, and carriers. And this is on basically the mobile advertising side. So this really surged during the pandemic. They were earnings positive for a smaller company. That's pretty impressive. They have a market cap of just $311 million. So to have positive cash flow, or not cash flow, but earnings, was impressive, but then that all came crashing down. So it is interesting to see it as a number one rank right now. Something good must be going on there. So I thought, well, is it time to return and take a look at Digital Turbine again? But we only have one analyst on it now. It used to have more than that, I think, but now we just have one. And they had adjusted EPS last quarter of 7 cents, but unadjusted, it was a loss of 25 cents. So just barely back in the positive there. That was Q1 2025 results for last quarter. But revenue still down 19% year over year. However, it was up 5% quarter on quarter. So just looking at those headlines, I was like, they might still be struggling. For this fiscal year, expected to see 37 cents, but that's down from 58 cents last year. And that's down from, what they were doing the year before that. So I don't like the trajectory, and I don't like that revenue, even several years into the downturn now, is still on the decline year over year. But it is cheap with a PE of just 8.2, and it's got that number one rank. Now, we only have, like I said, the one analyst is on this. And he or she, in the last 60 days. So that's all that's going on here. And earnings aren't until November, again, on Digital Turbines. So you're going to have to really take a listen to the conference call to find out what's going on. Shares are only trading at $3.08. So they have been trading in August under $2. Then they reported the earnings. It was a little better than expected. Shares did pop. So this seems more like a trade than an investment to me. And so I know many of you like that stock under $5. And this is one of them. So that's Digital Turbine, ticker APPS. Then I took a look at RMAX. That is a real estate brokerage firm. Many of you probably aware of it. It was founded in 1973. They have more than 140,000 agents in 9,000 offices in 110 countries. But the real estate side, especially on the brokerages, has been really hammered in the last 2 years since the Fed started raising rates. They're now cutting, but it's been really difficult to be a real estate agent. There's just, the sales are down 30 to 40% in the United States. I'm not sure what they're doing globally, but they're down big in the United States. And so the real estate agents have been struggling to even make a living doing it. So that means earnings have come down, and but they're starting to cut. So does that mean sales is going to go up? You're going to see a little bit better, a light at the end of the tunnel for the brokerages in the real estate industry. But we have one estimate actually being cut in the last 60 days for both this year and next year, and none being raised, yet it still has the Zacks number one rank. Sometimes there's mysteries in these things, right? But looking for $1.24 this year and just $1.26 next year. So the analysts that do cover this aren't all that excited about next year, not yet. Stock has been moving higher. So if you had gotten this before the Fed, was indicating it was going to raise, you would have had even a better deal than what it is now. PE of 9.4, you would have gotten it cheaper, because the shares are up considerably in just like the last 2 months, 2 or 3 months here, because of this hope, this optimism that, oh, the Fed is now cutting, real estate's going to improve, so I can get in these now. The worst is over. But is it? That's unclear. But people starting to get a little more bullish. I've seen the same thing on the chart as with Zillow. And those shares are off their low too. So people starting to look around in some of these real estate plays now as things change with the mortgage rates. But I'm trying to look. Okay, so over the last 3 months, it has seen a huge rebound. REMAX shares up 40% in that, but it is off the recent highs of the last month or so. Last couple weeks, it has pulled back. Zillow up 30% during that time period, and the S&P 500 up just 3.7. So it has had already a nice little move. And then it's come off the top. Is it worth getting in here? It's still cheap, 9.4 times. I would listen in on this conference call as well to kind of see what they're saying. But this is definitely a play on the cycle. So that's REMAX, ticker RMAX. Then there was this other company that stuck out. I wasn't familiar with it. It's called the One Group Hospitality. And I wasn't sure, was this a hotel chain or restaurants? They both use that term, hospitality. Ticker is S as in Sam, T as in Tom, K as in Kit, S as in Sam, STKS. I'm assuming maybe this was like a SPAC and then they changed their name or something to get this ticker, which does not go along with the One Group Hospitality at all. But it owns restaurants. And its largest restaurant group is called STK, which is why you're getting STKS. It's a short for steaks. STK is an American steakhouse concept, they said, with 19 restaurants in the US, Europe, and the Middle East. They also own Kona Grill. And then in May, they acquired Benihana and RA Sushi. That's going to double their revenue. It's going to raise it by 107%. They still have negative earnings, however, in the last quarter, and comps were down on the Kona Grill and STK by 7%. So in restaurants, just like with retail, you want year-over-year comp growth. You don't want it to be declining, but that's what's happening here with this one. It is declining. So that's probably why it's cheap. PE of 7.1. And this is also a small cap, but it's got that Zacks #1 rank. It does have an A for value in the style scores. It does have a D for growth, a D for momentum, and a C overall. Shares have actually been sliding year to date and are down. So that's why it's gotten even cheaper, right? That's one of the things. But is this a stock you want to be buying heading into a possible recession or continued slowing by the consumer? Steakhouse is the place to be. No, the street is saying no. Shares are down 43% year to date. And again, the S&P 500 year to date is up 22 now. So complete with reversal, but that's why it's cheap. That's why we're getting it at 7.1 times forward. There's going to be a lot because we didn't look for this, but there's going to be value traps among these stocks. They are dirt cheap, but you really have to take a second look and see whether or not it's truly a value, even though it says that it is. So the One Group Hospitality is very small with a market cap of just 112 million. And let's see, why does it have the Zacks #1 rank? It might have it because of that acquisition. The analysts had to raise earnings estimates because now they're going to double their revenue. And that is kind of what we're seeing. So earnings expected to be up 112% this year, but next year, another 50%. And, the acquisition was done in May. So they made 24 cents last year, expected to make 51 this year and 76 next year. So that's not terrible. Some good growth there, but maybe that'll be coming out of Benihana and RA Sushi. So you're going to have to check in on this earnings call as well. It's coming in November to see what is going on now that they've, had some time to do the synergies with these new brands. And we'll see, what is the consumer doing? Is the consumer still holding on? So that's the one group, ticker STKS. And then I was going to cover KT. That's all it is. It's just KT. And that's the ticker KT. But I did remember this one. I was intrigued by the 2 digits of the name and the ticker. That's easy to remember, right? But I thought that it was like a Korean utility or maybe Chinese utility. And then I was right. It is a Korean utility. They do wireless, broadband, and cloud. They do have a P of just 8. We've talked about them on this podcast in the past because they're always cheap and they continue to show up on these screens, even with the good stacks rank. But I didn't really want to cover it again. I wanted some new names. So I'm ditching it. But I just wanted to let you know I did consider it initially. But I ditched it for Mr. Cooper Group, ticker COOP, like COOP, COOP. And it's one of the largest home loan servicers in the U.S., mainly for the single family market. I know what you're thinking, like home loans, is that where we want to go? But those should be improving. As the Fed cuts, more people are going to buy homes and mortgage originations should rise off of these multi-year lows that they're at. That's good news for a company like Mr. Cooper Group. And I'm assuming that's why it's got the Zacks #1 rank. And sure enough, when you go look at the detailed estimates, 2 estimates are actually up for both this year and next year in the last 7 days. And none have been cut. And we're looking at, for 2024, earnings growth of 36%, 2025, another 34%. So they made $7.30 last year, expected to make $9.97 this year, and $13.39 next year. Also, some great double-digit revenue growth. This year, 27% to $2.28 billion, and then next year, another 23% to $2.8 billion. So you got to like everything you're seeing on this one. It's a C for value, even though it has a forward P of 9.2 and an F for growth. I'm not sure how it's got the F for growth with that growth that I just talked about, but it has an A for momentum now. Again, this is kind of like RMAX, where people are in it because they see that the Fed is now cutting and this is going to be a turnaround play in the housing market and anything to do with it, including furniture, home mortgages, probably paint, home remodeling, any of this stuff benefits from cheaper money and lower mortgage rates and more home buying. So all of those things are going to come into play with any of these. And honestly, when I picked this one, I did not know that they were in loan servicing and on the home side. And I might have avoided them maybe if that was the case. And maybe that's why it's so cheap right now, because everybody is avoiding them. But let's take a look and see what the stock is doing, because it does have that high style score for momentum. So I'm wondering if, that's where it is. And sure enough, yes, year to date, up 49% on this one. So everybody's already in this play, but looking further out, no, everybody's been in this play for 5 years. Shares are up 777% on the 5-year stack versus 94% for the S&P 500. So still making new highs here over the last year, up 70% versus S&P 500 up 33. So this is a hot one in the value category. Mr. Cooper Group. Let's see. Just curious because it has that low PE. Is anything else low? Price to book of just 1.3. Price to sale 2.8. So price to book is in the classic value category as well. Doesn't have a PEG ratio for some reason, not sure why, on Zacks, but PEG should be pretty good here, even with this big rally. So that's Mr. Cooper Group, COOP. And I really like doing this type of podcast and looking at these companies where I have not been familiar with them, because even just looking for Zacks number one ranks, and this has the PE under 10, will give me some hidden gems. That's what the rank is designed to do. And it certainly will with these smaller cap companies, because small caps are, influenced by just having the one analyst. You can get real bullish on the Zacks rank with just one analyst saying, hey, things look good, I'm raising my estimate. And so they do. And that's where you get a little bit more bullishness. This one is a mid cap with a market cap of about $6 billion, but that's still pretty small compared to, Mag 7 type of companies and just these 100 billion plus type market cap companies. And so this is what it's designed to unveil. So I'm liking that. Okay, and then we're going to wrap it up with another company that you probably have no clue about. I want to say I talked about it at least one time, but it's been a while. And it's called the Cool Company. How could I not cover that? It's ticker C as in cat, L as in Larry, C as in cat, O, CLCO. It's a Norwegian company. They're in shipping. They operate an owned fleet of modern fuel-efficient LNG carriers, as well as a fleet of LNG infrastructure and transportation assets. So LNG stands for liquefied natural gas. So they're moving around this important commodity, and things are looking pretty good here, and it's cheap. So the shippers can get really cheap depending on what's happening in the global supply chain and what's happening with those shipping costs and all of that, and even fuel costs will impact. So Cool Company is trading with a PE of just 5.6. That's really cheap. It's almost on the verge of like what's happening, but it's a Norwegian company. So pretty much everybody in America is ignoring it because they only, many people don't want to buy foreign companies. It is hard to get information on foreign companies as well, but just going to the investor relation page on Cool Company, I found there was quite a bit of information there and help on the investor relation page for those American investors, because they know that we're out here. And they are one of those that pays a big dividend. On Zacks, it's yielding 14.4% right now. It has a dividend payout of $1.64, but because it's a foreign company, it pays under that kind of weird, it's not weird, but different mechanism. And they have put out press releases about how the dividend works, when you'll get it as an American investor, how much it'll be in US dollars, and all of those fine things. So like I said, they do give out pretty much information for US investors, but it's dirt cheap, again, probably because people don't want to be in a Norwegian company that's in transporting around natural gas. So, but we might want to be, right? Especially for that dividend. I did not search for yield on this episode, but I wasn't surprised to see, something coming through with the yield. I'm just taking a look. The stock is trading at $11.29 right now. And so it is on the cheaper side. It's been all over the place, as high as $13.35 this year, and as low as in September, it did have a spike down to around under 10, it looks like. So yeah, no, just a little bit above 10. So you're in kind of this narrow trading range, but you're really owning it for the dividend, right? That's really what this one's all about. And I'm looking to see what the analysts are doing. So one estimate is up in the last 60 days. None have been cut, but Revenue expected to be up 64% this year, but earnings down 37%. That's what I mean by you're not always getting earnings growth just because it's the Zacks number one rank. Expected to make 203. It made 325 last year. Next year, so far, the one analyst has 209, which is just 3% earnings growth for next year. So the earnings growth isn't great, but they pay 164. You have to watch that dividend and with the earnings, because is that in danger of being cut? Is it variable every year? You might get less than 14% next year if it is variable. So keep that in mind as well for some of these big dividend payouts. But these stocks are still interesting, and you should put them on your watch list. Check them out because the Zacks number one rank is making them stand out here. The cheapness makes them stand out further, but it all depends on what your goal is as an investor. Is it for income? Is it for growth in the shares like with Mr. Cooper Group? Or are you looking for, some kind of deal or a turnaround play like with some of these others like Digital Turbine, RMAX, although that has already turned around, and the One Group Hospitality, which now has this big acquisition, and that may be turning around. So this was an interesting screen. I wasn't anticipating these stocks. Like I said, they're mostly small and mid caps, some really small. And so this is an interesting time to run the screen before earnings season. But we still got some interesting names out there to consider and to watch. And I will be doing so on a lot of these. So let me recap the stocks again. So we had Digital Turbine, which we've talked about many times over the years. That is back with the good Zacks rank. It's ticker A as in Adam, PPS. A, P as in Paul, P as in Paul, S as in Sam. Then we had REMAX, the brokerage firm. These are the real estate agents. Ticker R as in Robert, M as in Mary, A as in Adam, X as in X-ray. RMAX. Then we had the restaurant group, the One Group Hospitality with the steakhouses and Benihana. That one is S as in Sam, TKS, like steaks, STKS. Then we talked about Mr. Cooper Group, the largest home loan servicer, or one of them in the U.S. That one has been on fire. Ticker COOP is that ticker. And we had Cool Company, the shipper of LNG, ticker CLCO. And I mentioned KT, which is out of Korea, ticker K as in kite, T as in Tom, just two letters, KT. And as always, I'm trying to screen to find some good value stocks. There are quite a few. There were 45 stocks on this screen. That's a lot of Zacks number one cheap stocks. And these are the dirt cheap ones under 10. So we'd get even more if we just went up to 15 times. But I'm trying to find them for you every week. We are going into earnings season, so the Zacks rank is going to change a lot. The stories behind some of these stocks are going to change. We may get some sell-offs that present buying opportunities, but you want to be sure to subscribe to the podcast to get all of these stock picks every week. Get them on Amazon. You can get them on Spotify. We're on YouTube on the Zacks podcast page. But be sure to get us somewhere. And I'll see you again next week with some more value stocks.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.